Welcome back, everyone, to another episode of Wolf Street. There is a video version of this audio podcast available on YouTube at Every Time I Cash. You can check out the video version if you'd like, or you can just feel free to listen to the audio version. Today's episode is going to cover basically where we were before all of this COVID-19 stuff started happening, where we are currently, and where we can potentially go. Along with that, I'm going to try to cover the idea that coronavirus or COVID-19 or whatever you want to call it was not the reason that we found or find ourselves in the situation that we're in currently, but rather it was just the match or accelerant to escalate tensions and escalate things to where they got. I'm going to go over particular levels that we were watching previously. This is going to kind of be in conjunction with a video that was put out about 4 weeks ago. We're going to see that a lot of the levels that we were looking for originally did in fact hit. We're also going to see that when you're looking at levels on the way up, so typically the market goes up more than it goes down. That's just the way that it is. 70 to 80% of the time we are in a rising market. But you will see that when things lock up and dislocation occurs, that these levels tend to hit pretty quickly and pretty aggressively. So as I was saying about a month ago, you will see that a lot of the statements about you never know how fast or how hard this thing's going to fall were in fact even understated on my part, regardless of how often I was saying, don't try to time the bottom, don't try to buy the stocks here, don't try to thread the needle here, just wait for it to give you a sign. So without further ado, I'm just going to get into it. On your screen, if you are watching, there is a Nasdaq futures chart. You'll see that this is a chart from the year 2000 all the way until late 2016. And the reason that I'm starting here is because I want to illustrate a point to everyone that is watching that typically when you set a benchmark high, so I'm going to set a high here on the Nasdaq in late 2000, when you set a high and it's followed by a terrible set of events, you usually need a long period of time to work off the damage, especially when there was a bubble of some kind that took place. Now, I'm not saying here that there is a stock market bubble necessarily, but I will point out that these issues that we had in the market itself and in the underlying market itself did exist before coronavirus took center stage. So I'm just showing you here on the Nasdaq that it took us roughly 16 years to work off the damage that was created in the bubble. So from there, I'm just going to go over and I'm going to look at the S&P 500 E-mini futures, and I'm just going to go over where we were, where we are, and where we could potentially go. And I just kind of want to illustrate how these things played out and how they potentially play out for the future. So in front of you on your screen, you're going to see the weekly chart for the S&P E-mini futures contracts. Very simply put, the pink arrow on your screen identifies the level that we were at when I was originally signaling that something's going on that shouldn't be going on. The blue line and arrow, well, the blue line for now, don't worry about the arrow. Let me just move that over. The blue line for now will signify the first level that I was looking at as potential support, which was right around 2950. If you want to round number it, it could have been 3,000. It's not particularly important to try to nail the exact level, more so important to kind of draw level ranges to look at. So I'm going to go from the weekly here, and I'm going to go to the daily. On the daily, you will see, like I said, this 3,100 give or take level, and it started on for me, it started on the 27th of February, where I was really starting to hammer things to people about, hey, don't try to buy the bottom here. You're going to get a lot further downside potential if things play out the way that they should. So personally, I signaled much earlier that I was out of stocks and equities in general, and I was waiting for a reset of some kind or a telegraphed signal for me to get back in. For me, I'm like I've always said, I'm a momentum trader. I try to find momentum. I try to trade around momentum indicators. So for me, I try to use the 5-day and 20-day as often as possible to signal whether or not I want to be in something. So that said, the 3,100 level was just a revisitation of the broadening megaphone pattern that we saw over the course of 3 years. So in late 2017, we saw a sell-off. It was potentially Fed-induced, and it started this broadening megaphone. In late 2019, in November, we broke out of that megaphone and we accelerated to the upside. We grew really stretched in valuations, pretty much no matter how you looked at it. And I just want to highlight some key things to keep in mind when we're talking about this moving forward. So first and foremost, like I said, coronavirus didn't start all of this. It just lit the fuse. So in late February, the overall hedge fund leverage was basically in the 99th percentile. It depends on where you look, but leverage was at 99th percentile, and this was as of February 20th. So a week before we started to really start seeing dislocation in equity markets and in pricing, and before we started to see accelerating selling, we were already in as leveraged as we've ever been when it comes to hedge funds. This goes at about 7 times the average leverage. So if just to put things in context, if you've got a book of any kind, whether it's a hedge fund or whether it's your own book, or it doesn't really matter. But if you are 5 times levered to your overall cash, it will basically take a 20% drop in whatever position you're in to blow you up. And so as prices dislocate further and as things start to sell, it requires less and less selling to blow up more and more people, which only exacerbates the problem. It's a completely negative feedback loop. I will try to go into a little bit more depth on another episode, probably the one after this one, to try to explain some of the things that were going on under the surface and to try to give an opinion about how it is that you want to think of things moving forward when you are putting in price objectives and when you are looking for targets in trades and when to put on trades. But for now, let's just focus on the levels that we were watching and how it played out and what it was that we were keeping in mind at the time. So at the time that all of this started to cascade, the thesis behind it was that China had to go into lockdown in order to stem the risk of coronavirus, and that lockdown was going to be replicated in some form or fashion across many countries, and in our case, the United States. And that sort of gridlock or lockdown was going to show some sort of panic in equity markets, and that sort of panic was going to create dislocation, and that dislocation could potentially, and I'm not here telling you that like, oh, I saw this coming and I knew exactly what was going to happen, but it could have exacerbated a problem and made things a lot worse, and that is in fact what ended up happening. So like I said, late late February, we were in 99th percentile of leverage. A reason that the coronavirus was an important matchstick to light this entire fuse on fire is that if you just take out debt, if you just take out debt products out of the GDP, our GDP has been running at negative without constructed debt products. So like if you just wipe out the ability to create debt and have that be a function of GDP, then your GDP has been running negative. And this is not just in the United States. This is a global thing. Just the way that the system was working and has been working is if I want to create some sort of growth, I don't do it organically. I create growth by issuing debt and then going from there. And you saw this on a bastardized version when it came to corporate buybacks and CEO pay and CEO governance and CEO issuance of stock options. Basically, there were no real buyers in the marketplace when things started to break. And they started to break well in advance of this most recent sell-off. And what CEOs were doing, and this is just like a repeated thing, this is something that I said about a year ago, they were just issuing debt to buy back their stock, which was inflating the asset price, which was inflating their own stock that they were issuing to themselves, which was allowing them to sell their stock at a higher premium, which increases their net worth. So if I'm a CEO, I have to be a dignified, like the whole is greater than me individual to overlook that. Because if I was a CEO and I was not enhancing my share price, I was viewed as doing a disservice to my shareholders, when in reality the opposite is true. But no one understands that the opposite is true in the moment because everyone's just so near-term sighted and everyone is so in the now. So anyways, I'm just going to go over the levels that we had back then, and I'm going to show you how these things played out. So the levels that I had, this was about a month ago. You can go back and you can look at the video. It's on my YouTube. 3090 was the first support level highlighted by this pink arrow. That was the megaphone support that should have held if it was a basic retest to move higher in an uptrend. Below that, we highlighted 2950, give or take, so it's here. We highlighted 2850, so it was here, give or take. We highlighted 2730, and that was right around this sell-off low from June 2019. We highlighted 2550, and 2550 was this low that was these lows that were being put in place back in early 2018, and prior to that, it was the origination of this megaphone pattern low. Below that, we highlighted 2480. 2480, where is it? It's this line here, which was a breakout level that we watched previously. It was a breakout in late 2017 when we were going sideways, and then we started to accelerate into the sell-off that happened late on the back of late 2017, 2018, late 2017, early 2018 on the back of a Fed interest rate hike. We then started to highlight the 2320 level. I'll call it 2300 if you want to be round number guy. 2320 was this the 2018 lows that we set, and those 2018 lows coincided with a long-term uptrend. And then ultimately 2120 was the next level, which was this sideways range breakout that happened in late 2016 on the back of the election. And then ultimately my target was this green arrow, which we never actually got to, but we came close enough. And that was the bottom test of this megaphone. And it was 2000 to 2020. Doesn't really matter how you want to, what number exactly you want to use, but call it 2020 just to be safe. So below that, personally, I was shooting for 1800, which coincided with the 2016 lows and the 2014 lows. So ultimately, my goal was to see 1800 get tested. We didn't do that. I wanted to see 2000 get tested and hold. We didn't get that. Personally, I went long 317 2020, so March 17th, 2020. 317 2020 is this date here on your screen. And for me, I was just looking at potential downside risk and where I wanted to get long on a piecemeal basis for a potential bounce. So I wasn't necessarily saying, hey, this is the absolute low. I was more inclined to say, 2100 is, or 2100 is my next level, and then below that 2000 is my next level. So I like the idea here of looking for a potential bounce. You'll see very clearly that I didn't nail the absolute bottom. So I nailed this arrow here. I'm going to put up arrow for you. You'll see that I entered here. You'll see that there were still 1, 2, 3, 4 days of volatility and selling before we hit an absolute bottom. Our absolute bottom was, call it 2180, give or take, on the ES. The concept here, like I said, is I was looking for a tradable floor. I was looking to leg into things. I was using a portion of wealth. I wasn't using a large portion of wealth. I didn't know where the bottom necessarily was going to come. I had targets. I was about 100 points away from, or 200 points away from a target that I had set previously. Ultimately, my ultimate target was 1800. If we got there, I wanted to look to be adding more. And then if we got to 1500, I wanted to add even more. And then if we went below that, we had bigger problems. So that's kind of how I thought of it. There's a little bit more depth to it. I offered the PDF file to it. If you haven't gotten a PDF file, or if you want to check it out, please just drop me a line. everytimeicash.com/contact. On the way back up, I want to emphasize that, first of all, we didn't see any particular sustainability to any sort of rally until we broke above that 5-day moving average. I'm highlighting it here on your screen. And that 5-day moving average breakout and hold coincided with this downtrend channel that was going on with S&P futures. So personally, I was looking for some sort of trigger like that before I said, okay, coast is kind of clear in the short to intermediate term. I'm going to now use my ability to get in. I'm going to be very candid. I didn't really get aggressive or anything like that, and I didn't really hit any real major home runs outside of low float, small, basically disproportionate trading vehicles to the market. So just think of things like Tilray and things that are super low float and don't really impact the market. I didn't really hit very many of the Nvidias, for example. I didn't step in with real substantive buying power for Nvidia or stocks like that. I did hit Tesla on the reset, so I'm gonna just pull Tesla up just to give you an example. Personally, I did hit Tesla. Tesla retested its breakout lows of around 350. Or let me just move this up, make it a little bit more clear. Tesla did test 350. I was looking for a retest of that breakout that it had. We got it. Personally, I went long Tesla once it held the second time. That is one that I did hit. I did not ride it anywhere near as close as I could have or should have. I'm just being transparent here, and I wanted to just give you an example. Another one that I personally hit was Amazon. Let's pull it up. Amazon had been showing relative and absolute strength. So that is one that I did in fact nail. I mean, if you just show you here, as of March 18th, Amazon was one that I actually bought right around that time, pretty extensively. But again, I hit that initial break, but I didn't. It's not like I'm holding Amazon today or I rode it for $300 or anything like that. The point that I'm emphasizing here is I had a thesis for the market to go down. I was correct on the thesis. I did kind of pound the table a little bit more aggressively short than I have been shorting anything in the last few years. It did work out. I was fortunate enough to cover the majority of the short towards the lows. I didn't nail the absolute low. I didn't try to nail the absolute bottom to rally back up. I did look for things that traded independently of the market, and I did happen to nail a few of those things. But the thing that I'm trying to illustrate is I was looking at a couple of items. So I'm going to go back to the NQ here. The Nasdaq in general was trading better than the overall market was towards the tail end. And I'm going to illustrate that the Nasdaq bounced pretty much directly, and you'll see it here with this. Let me make this arrow green. You'll see it here with this green arrow. The Nasdaq did bounce pretty much right in line with its 200-week moving average. So when I saw that there was some sort of constructive behavior taking place, and that was something that I wanted to look for. And so I was geared to look towards how the Nasdaq would behave, and I was looking towards Nasdaq stocks. In general, for me, I use the 5 and 20 day pretty religiously. Those are the kinds of those are the primary mechanisms that I look at for going long or short. It doesn't really matter which direction, but 5-day and 20-day momentum averages for me are something that I watch, and then from there I just expand my time horizon and I expand the different levels that I'm watching. There are always, and not always, almost always asymmetric setups that you can look for. Again, I was looking at Tilray at one point. I was looking at U.S. Steel at one point. And you saw that last week. You saw it with a lot of the beaten up cyclical consumer discretionary names. You saw it with like Wynn Resorts. You saw it with airlines. You saw it with oil and gas stocks. And basically the concept here is at some point, once you get past the initial shock of whatever has taken place, you're going to see whether it's artificial, temporary, whatever, it doesn't matter. You're going to see some kind of floor come in, and you're going to see some sort of aggressive short covering. If it's a short, you're going to see some sort of buying that will escalate the price higher. And primarily that's a function of seller exhaustion. Again, for me, it's a 5-day, 20-day scenario. It can be a litany of things for you, but that's primarily what I use to trade. So with that in mind, I'm showing you the NQ here still. I'm going to take this downtrend off. You're going to see here that we are in some form of rising wedge. So as soon as I noticed this, I was looking personally for this blue arrow, which coincides with the 50-day, as you see. I wanted to stress that. It coincides with the 50-day. That essentially was upside potential for me. Sure, it can get higher than that. You can say it gets to 9,000. The point here is not to say where is the top. The point here is to illustrate that as we're going higher, it's getting riskier and riskier to anybody that bought lower or anybody that held through this entire drawdown. So obviously coronavirus did have an impact, but that was not the reason that we got so disjointed. That is a reason. It's not the primary reason. And it can, again, be a reason for us to break again. It can be a primary reason for us to break again from this point forward, given that it will have a material impact on GDP, etc. But for me, I am looking for some sort of reset, whether it's lower, whether it's retesting the lows. That remains to be seen. But for me, as we get higher and higher, whatever I have, I'm looking to protect more and more. So as of Friday, I protected that long position that I put on in mid-March. I'm shorting, or not shorting, I'm hedging that position with QQQ puts and selling futures. I'm watching this rising wedge, bear flag, whatever you want to call it, on Nasdaq futures to see where it is that it tops out. I'm also keeping in mind the following, that despite the fact that we've gotten a 25% rally, give or take, I don't know the exact number, somewhere between 25 and 30% rally off the lows in the S&P 500, we are still in a situation where 17% of S&P 500 names are still below their 200-day moving average. This is the illustration here is just how fucking bearish things got at the tail end of that sell-off. So we got so broken and so beaten down that so many of these names, despite having this pretty extensive rally that we've had, are still below their 200-day moving average. So that's number one. Number two, 14 names in the S&P 500 last week rallied over 50%. And that, again, illustrates to you just how bearish things got towards the tail end of that sell-off. I have, again, the S&P ES chart in front of you. If we were to get back up to this megaphone pattern, let me move this arrow back over. If we were to get up to there, I mean, it just depends on how long it takes for you to get there, but you're looking at a potential 3100 failure if it was that aggressive. We're looking at the 200-day on the S&P futures being somewhere around 3,000. So we can fail somewhere around 2,900. We can fail here. We can fail at 3,000. We can fail 3,100. It remains to be seen. But the point that I'm trying to illustrate is, moving forward, you need to start to think of things as probabilistic events that could or could not happen, and what the likelihood for those events to materialize in upside progress versus downside progress. And should we get closer and closer to these levels, we should, in theory, see further resistance, and we should see more people that want to be made whole try to lock in their profits. On the flip side of that statement, I'm going to pull up the IWM. The IWM still has significant room to run relative to those other indexes that I showed, because the IWM showed material weakness throughout this bull market that we've had the last few years. So we never confirmed that high that was set back in 2018. We never confirmed it on this most recent run-up in January and then again in February. And the IWM is at some sort of critical inflection point now, being that 125 level, give or take. And we could, in theory, rally. They could issue some sort of stimulus package. They could do whatever they want to grease it, and we could rally to 137 or retest that uptrend that we'd broken, and we would still be significantly and materially lower than the highs that were set in 2018 and the high that was set back here in late February. So for me, moving forward, if I'm looking for going long a particular position, I'm looking for these kinds of positions that can perform, and I'm using the IWM here as a generalized statement, positions that can perform with asymmetric risk and to the market, and can perform domestically versus having international exposure. And you're going to see a lot of these themes start to play out moving forward, and you're going to see a lot of these statements start to be made moving forward. So I just wanted to show how things played out, and I'm going to just go back and just give you a generalized view again on the ES. If I just zoom out, you see we have that megaphone. You see that we started to break down. Delete that. We started to break down once we broke back below that megaphone, and then at that point you just start to mark level after level after level, and we were just zoom in so you see we were just testing a level, breaking a level, back down to the next level, testing a level, holding, breaking back down, and then it's to the next level. And we did that all the way until we got pretty close to that 2130, call it, level that I personally was watching, and that was, again, the sideways action that we got for basically 2 years before breaking out after the election. So this is kind of just to give you a little bit of an idea of how it played out, and to kind of give you some of the thought process that I was going through, or I was using rather, and to give you an idea of where it is that I'm looking at moving forward and how I'm looking at things moving forward. On a future episode or on a future video, I'm gonna go into a little bit of the specifics that we saw that kind of broke this thing, and then I'm going to go over some of the concepts that I'm using to give myself the logic. And these are concepts that I've garnered from people that I've talked to who are money managers that manage, one in particular that I lean on. Guy manages my money and manages over $10 billion in assets. And then just other things that I've picked up from people that are what I deem to be reliable sources. So a lot of times this is not a thing that is my own, idea. It's things that I've been taught, and they're ideas that I've cultivated. Some of them I have come up on my own, but in general, they're ideas that I've cultivated. On the next episode, I'm going to show a little bit of a grid that I kind of started to think about objectively and just said, how do I visually represent what most traders look like? And it's going to be a comparison between the ability to price out risk, so to gauge what risk is like, versus the ability of risk tolerance. If you like this content, please like, subscribe, and share it. Please leave me some comments and feedback. If you want to reach out to me directly at EveryTimeICash on social media, or www.everytimeicash.com/contact. If you have any ideas, questions, comments, etc., please use the comment section below, or at me online on social media. Please, again, like, comment, subscribe, and stay tuned for the next content. And as always, stay locked in.